over here. But to before we begin with the session, I would like to introduce our today's speaker who is going to conduct the session for the day, Associate Professor Ankur Srivastava sir from School of Management, a diversified personality with experience ranging from auditing to academia to corporate. With initial education in science and higher education in finance, he has always been an avid learner, knowledge seeker, team leader, and a team player too. He enjoys, I guess someone is on unmute. Okay. He enjoys the areas requiring analysis, interpretation, and forecasting. After completing MCOM and PGDBM, he completed his CFA program certification USA Level 1 in the year 2022. He is also SEBI certified research analyst under SEBI regulation 2007 and NEC certified market professional. He has also empaneled with SEBI as SEBI NISM certified as financial literacy resource person. With over 26 plus years of industry and academia experience, he is very well known, especially in School of Management, Pimpri Chinchwad University, as a person who makes non-financial background students comfortable with the numbers and cherish through their learning processes. He has motivated and guided hundreds of learners secure various certification from platforms like NPTEL, NCFM, NSE, and NISM SEBI. He has worked as Director Business Development with MK Process Technology Private Limited, New Delhi. So we have a person, a resource person who is having a very varied background with finance and investments, and that's why we are very honored and privileged to listen from him what exactly means by investment. To begin with the session's topic, demystifying investment for beginners, I welcome Ankur Srivastava for the session. So, sir, over to you. Please enlighten us with how exactly we can do our investments. Thank you so much.
Thank you, Professor Aboli. Thanks a lot. And good evening, all. And I welcome all the listeners and the learners to this session. Hope we have some takeaway from this session at the end of this session. Every one of us who is participating have something from this. Let just give a moment to share my PPT. Madam, can you confirm if my presentation is visible?
Yes.
Yes, sir.
Okay, thank you. So today's topic is demystifying investments for beginners, and I would try to keep this subject as simple as possible. So before coming to investment, one disclosure, because I am a SEBI research analyst. So this disclosure is that whatever I am talking about, this is just for purely academic purpose, and in no manner whatever I talk should be taken as investment advice or recommendation. So whatever little knowledge I have, I can share, but based on that, decisions you have to take yourself, and it will be your own decision, not influenced by my presentation. So let us start with the basic thing, that all of us need money, and there is no doubt about it. It could be, money could be in any form, in any country's currency, but all of us requires money. And there are various needs for why we require money. There are various different requirements. That could start from some basic requirements like food, that could be your clothing, that could be education, that could be marriage purpose, that could be buying a house, that could be spending on your kids, that could be your running expenses, and that could be on security. So the need for money have various needs are there. So every one of us need money, whatever the purpose or requirement is. So these needs could be varying. However, apart from needs, once you are somewhat comfortable with the requirement, that means you are getting enough money, people have some tendency which is called as overspending or lavish spending or living a luxury life just to impress people who actually you don't want or you don't like. So this habit is at a later stage once you are satisfied with your basic needs. However, all of us will work for money, and why we need money, it is because of various reasons as we have seen. But one thing should be clear, whether money should be construed as a mean or an end. Means we have seen, and I personally have seen many people who have the goal of earning money. That goal of earning money cannot be any goal, because if you keep on earning money and don't use it, this can never satisfy any of your basic requirements as a human being. So money is just a mean so that some of your goals could be met. The next question arises, how much is enough? That depends from person to person, depending upon his needs and wants. So the basic question arises whether you need it now or you need it later. So the main factor is the time. Time is, maybe you have the consumption requirement present, or you have the consumption requirement that you can defer. If you can defer your consumption from today to a future point of time, this becomes savings, and this savings can be invested. So into investing, the main focus, main parameters on which you can accumulate wealth doing investments, the first factor that is to be kept in mind is the time factor. So if you can give time to your money and keep it untouched, you are surely going to build wealth. These are the two main parameters. One is giving time to your money, and second is that you don't touch it. Now, let us talk about wealth. So, wealth is what everybody requires, and there are three processes, three steps in the concept of wealth. First step is wealth creation. That means you can create wealth, and this is considered to be a relatively easier step. So anybody who wants to create wealth certainly can create wealth. And this is a process, if you give time and don't touch your money, you are going to create wealth. The second step is wealth preservation. This step is somewhat difficult as compared to the first step. Wealth preservation means you have created your wealth. Now, whether you are able to maintain and grow it or not, this becomes wealth preservation. What happens? Most of the people who have created wealth, once they have seen it, they start deteriorating it. That means they start spending lavishly and their wealth starts depleting. So, this second step of wealth preservation is somewhat difficult as compared to the first step. The third step is most difficult and somewhat missing in the Indian context. Why you are creating wealth is actually you can enjoy the wealth. But most of the people, as they get wealthier and wealthier, they stop enjoying wealth. So, whenever wealth is created and preserved, the next or last step must be fully satisfying the human wants. So, whether you are able to enjoy the wealth created and preserved is the most crucial step in anyone's life. Now, let us have a look at the wealth pyramid. So, this wealth pyramid, as you can see, the base is production, and this pyramid is across the various life stages of any human being. As the life stages move upward, it grows. So, what is the basic requirement? It is the protection. The first thing you require is the protection, and that protection for different people could be different. For example, what comes in the protection category? It could be insurance. The insurance, the insurance could be health insurance as well as life insurance. So the first step that anybody should do is to insure him or her for his or her for health. This is the first step that should be done. Second step is doing or taking a life insurance. Life insurance could be of two categories. One is term insurance, another is endowment. Normally, people take endowment plus term. Term is a pure insurance, means it covers purely the risk of life and don't give you any return. It is just like the cost. So, what people do normally in India, they take insurance of life as an investment plan because of certain tax savings. However, this approach is not correct. The correct approach is you should take life insurance, that is term insurance, and for the money saved in the premium as compared to the endowment policy, that you should be investing. So, what I want to say here is that the term insurance and endowment policy, the point I want to make here is very clear that the insurance is not an investment product, it is a risk product purely. So, don't ever mix insurance with investments. Now, once you are protected, the protection for first is health insurance, second is life insurance, third could be buying a house. For many people, having a house is a primary requirement and they see it as a protection to family. So, the third protection, especially in India, could be buying a house. The fourth protection, which every salary person should do, is creating a contingency fund. That contingency fund should be of at least 3 to 6 months of his or her monthly salary, so that in any contingency or adverse position, you can utilize that fund for protection against loss of service. Once you have all the protections with you, then you start saving, and those savings could be converted into investments, and whatever investment yield provides you, that should be ready for consumption. This is the ideal wealth pyramid. So keeping this pyramid intact will lead to wealth creation, preservation, and enjoyment. So this what we have talked about generally. Now let's come to the topic, which is investing. Am I audible? Can you confirm? Okay, thanks. So this is what we try to cover as time permits. I will be covering these things. One is basics of investing. The first point is, let us talk about investment, trading, speculation, gambling, arbitrage, hedging, and things and words like these you have heard. Second, we look at investment process. Third, we should know about various asset classes, also known as various investment avenues. Third, then we should know about investors' attributes. What are the objectives of investors and what are the constraints with the investors? The next step is aligning these asset classes and investor attributes and making execution of the portfolio. The next step after execution of the portfolio is evaluation, monitoring, and rebalancing of your portfolio. In the last, we will have a look to a good investment choice for the retail investors. So let us start with the first point: investment, trading, speculation, gambling, arbitrage, hedging, and the words like on. So first, let's see what is the difference between the three key terms: investment, trading, speculation, gambling. And remember, these terms could be exchanged or taken as synonyms for different category of investors. What is investment to one could be trading to another. So let us see the first three basic: investment, speculation, and gambling. What is the difference? If you see this, the nature highlighted one, this is the key difference. So investments are thought to be carefully planned, very carefully planned. Speculation could be planned as well as unplanned. For most of the people, normal people, it is unplanned. But who are related to this field, they can speculate after planning. The third one is gambling, and which is naturally and normally unplanned. What are the examples? So if you go about investments, it could be stocks, bonds, mutual funds, real estate, any precious object like gold. It could be speculated also. Say if you talk about shares or stocks, you can have investment in stocks as well as speculation in stocks. Derivatives are meant to be hedging instruments as well as speculative instruments. If you come to gambling, it could be winning lotteries, going to casinos, card games, races. Now, what is the difference between all these three: investment, speculation, gambling, in terms of return expectation, time horizon, and risk? So, if you go for investments, your expected return is usually high, but you speculate, you normally expect a very high return. And if you gamble, it is extreme. Extreme means not only in terms of return, it is extreme in terms of risk also. However, with investments, the risk involved is low to high, and speculation, it could be high to very high. So accordingly, the attributes for a person doing investment, speculation, and gambling, they are, in case of investment, they are high risk covers. In case of speculation, they are low risk covers. And in case of gambling, they are risk seekers. Now, one main factor which differentiates it is the time horizon. So, investment is for the long term, speculation is for the short term, and gambling is for very short. So, if you gamble on, say, horse races, this will be decided very quickly. Likewise, if you go to casino, it can be your very short term period, which will give you a good return or a very big loss. Now, this long term and short term and very short term, they are not very clear. So, any person who does intraday trading, that means he buys or sells within a day, for him, a week's period or a month's period could be a long term horizon. So that could be a long term. But for an investor who buys stocks or bonds for long term, like 5 years or 10 years, for him, a month could be a short term period. So these terms are to be seen as per the nature of the person making or investing money. Now, three terms are not covered. Investment, speculation, gambling, we have talked about. The other one is trading. So trading could be seen as a short-term investing activity, which may or may not include speculation. The next term is arbitrage. Arbitrage means making riskless profits. So arbitrage is the basis of most of the advanced concepts of finance and investing. So whatever options you see, like put option, call option, many strategies like straddle, they are based on and built on the concept of arbitrage. What simply arbitrage means, making profits without taking any risk and without making investment. This is what the definition of arbitrage is. So how it can be done, and it is being done in the stock market for long, not a new concept. What we mean by arbitrage, let us understand arbitrage with the help of one example. See, for example, let us take example of vegetable markets. So in a locality or in a district, there are many vegetable markets. And for instance, let us take example of two different markets, vegetable markets, and you have one vegetable selling at two different prices. So let us say potato is selling at 30 rupees in one market and 32 rupees in another market. So this is the differentiation in price for the same quality of product at two different markets. So anyone who is aware of this price discrepancy in the same asset class can take advantage of this price difference and can buy potato from one market where it is selling at 30 rupees, buy and sell it in the market where it is being sold at rupees 30. By doing this transaction, one can make a profit of rupees 2 without, and these two, remember, these two transactions happen simultaneously. So there is no difference. That means it could be done on a phone call. Suppose I am doing this transaction, then I can on a call buy a kg of potato and on another call at the same time I can sell it at 32 rupees. So these two transactions are happening at the same time. Therefore, there is no risk, or it is known as riskless or risk-free profit. And why it is said that there is no investment? So arbitrage, we are doing it on a telephone just by selling and buying. You may require some margin for it, but that margin is also not required for a short period or long period. So by this manner, you can have riskless profit without making any investments. This is the concept of arbitrage. If anyone have any questions, you may write it in the box. Just give me a minute. Okay. Now, let us talk about 2-3 steps, the main important concepts while we talk about investing. Investing is all about greed and fear. So, whether it is any asset class, maybe stock, bond, real estate, or any other thing, these assets or this investing is primarily guided by greed and fear. So what you have seen in the past 2-3 days, what is happening after election, it is the greed and fear both playing their level. So why one person is willing to sell a share at a price where at a price sorry, at a price where one should buy, is ready to buy, and another is ready to sell. Why this discrepancy is there? So say for example, one share of X Limited is currently traded at 100 rupees. So at 100 rupees, one is willing to buy and another is willing to sell. This is what is happening. So that means there is greed that this 100 rupee share is now cheap. So one who is buying it must have some greed, or one who is selling it must have some fear that it will not rise above 100 and it could slip down to lower levels. This is known as greed and fear factor, which plays in any market, especially stock markets. So there is also FOMO. Here it is written. What we mean by FOMO? FOMO is fear of missing out. If you see the rally going on in India for the last 1 year or so, most of the people jump to buy stocks looking at the profits earned by other people. That means they are unhappy that they missed this rally and they remain unparticipative. So what happens? They buy stocks at a higher level and may suffer loss later on. These are different behavioral biases which are always present in the market, and these are not something new. To just give you an illustration, I would like to show you one such incident in the history called as tulip mania. Tulip mania is one of the greatest just just a second. Okay, I hope this is visible.
Yes, sir.
So the Dutch tulip mania. So we all know that tulip is a very famous bulbous flower from Holland, and one of the major crashes, all-time crashes, is Dutch tulip bubble market. It is one of the greatest crashes of all times. And when it happened in the 16th century. In the 16th century, what happened? All the Dutch people are so obsessed with tulip flower that every one of them started buying tulip flowers, even by selling their precious metals like gold. They are exchanging assets for the sake of buying tulip flowers. And this becomes so rash that even once this tulip flower got a disease, because of which they got different colors, and that color also becomes so popular that it goes on increasing further and further, and it reaches to such a level that for few tulip flowers you can purchase, by exchanging few tulip flowers you can even buy a big house. So this becomes the state of craziness by the people who are, this is known as mob, mass mob nature, herd nature, what we call as. So everybody started buying tulip bulbs and at such price. Ultimately this has to crash, and it crashed. So why I have cited this example, just to make you understand that there is nothing new in investment, speculation, and gambling. It is happening since centuries, and the human psychology normally doesn't change. The human behavior normally doesn't change. Now, to make things simple, you should understand the concept of compounding, which even Einstein has said that compounding is the eighth wonder of the world. So, to understand the concept of compounding, we will understand it at the end by looking at some Excel. Now, the second is the investment process. So, what is the investment process? I just want to give you some introduction. So, it is the planning. Whenever you are investing, you are planning for certain things, your investments. While making the plans for your investment, you have certain objectives and you have certain constants. At the time of planning, also, you have some benchmarking. Benchmarking means you have some yardstick that I want a minimum of this return, or I want a return of greater than the Nifty return. So benchmarking could be absolute benchmarking, it could be relative benchmarking. Benchmarking is simply the yardstick to compare what yield you want. So at planning stage, you have to decide about the objective and constraints, and you have to decide upon the benchmarking. Second step is execution. Execution have three steps. One is asset allocation. Asset allocation means if you have say 100 rupees, so how do you want to invest your 100 rupees, in which asset classes and in what proportion? Once you have decided your asset allocation, then you go on selecting security asset wise. Once you are done with your security selection, you are going to execute your portfolio. You will construct your portfolio, what we call as walk the talk. Now, if you have seen anybody, if you encounter with any person who comes with who has knowledge of investing, most of the time they are busy in this security selection. Security selection is very simple. Say in terms of stock, you have seen many people talking, tell me which share should I buy, which stock should I buy. So that security selection or share selection, I have written the percentages. The asset allocation means, for the sake of simplicity, let us say there are only two assets. One is equity, another is debt or bond. So once you have decided that I want to invest 80% of my money in equity and 20% of my money in debt. So this asset allocation is the first step. And the second step of security selection is, what different securities should I select in 80% of equities, and what different bonds should I select in 20% of the debenture portfolio or bond portfolio. And third is executing the portfolio. So most of the people generally are devoting their time in security selection. And one study have conducted which said how your investment returns are guided or determined. That research study showed that 96% of your return is decided by asset allocation, not security selection. In security selection, we have two different approaches. One is called as top-down approach, another is called as bottom-up approach, which we will see in the next slide. So you plan for your investments, you execute by making asset allocation, security selection, and portfolio construction. Once you have executed your portfolio, you need to do the performance evaluation. Say you have bought some share now. So you must be willing to know the performance of that share, say after 3 months, 6 months, a year, 3 years, 5 years, or 10 years, so on. So that performance evaluation is the feedback. And you need to always monitor it, and what, if required, you need to rebalance it. Rebalance it means, if any asset share, if it is now not performing well, then you may decide to disown it or sell it. And if you want that, if you come to know that there is some better opportunity available in the market, even then you can dispose of your current investment and switch over to the next investment, better investment. So these are the three basic investment process steps. One is to plan, second is to execute, third is to review, always review and have feedback. Now, in the security selection, where people are mostly devote their time, there are two approaches. One is top-down approach and another is bottom-up approach. Top-down approach is also known as EIC. EIC. EIC means E stands for economy, I stands for industry, and C stands for company. And reverse is also possible. CIE means company, then industry, and then economy. So these are two different approaches for security selection. What it does mean, when it is top-down approach means you are going to study the macroeconomic conditions first. That means you start with economy, then you come down to industry, then you come down to the company. For example, maybe think from the perspective of a global investor. So any global investor is first looking for the search of any suitable country to invest in. So that country is means economy. So that global investor may choose India as a preferred destination for investment. That once decided that I am willing to invest in India, then the second step is to decide which industry to invest. So that could be IT, that could be cement, that could be hospitality. So a number of industry options are available. Once you zero in the industry options, then you zero in for the various companies falling within that industry. So if you are choosing, say, cement industry, then there are a lot of options like Ambuja Cement, ACC Cement. So this flow is from top to down. That means you come to the economy first, then you choose a particular industry, and within the industry, you make a selection of the company and you invest in that company. The reverse is the bottom up approach. The bottom up approach is that you select a company first based on certain qualities, maybe good management quality, maybe any based on any product or price differentiation specific to that company. You select a company, then check it upwards. That means whether that company will be successful where this industry or where this company is operating. That means in the industry in which this company is operating have prospects or not. Then once you are satisfied, okay, this company is operating in an industry which has good prospects, then you check the prospects of that economy or country. So whether that country has good prospects or not. This approach of going from company to economy is known as bottom-up approach. Now, what is the all fuss about investing? So we have asset classification, which actually is various investment classes where you can put your money. There are different attributes. Attributes relate to investors. So one thing we have regarding investment, second thing we have regarding investor. So we see what investment assets classifications are available, and second we see what investor attributes are. Once we come to know these two things, investment and investor, we try to align these two. That means we try to align assets and attributes. We try to match investment options with the investor needs. Now, coming to the asset classification. Globally, there are 4 asset classifications. One is equity, second is fixed income. Fixed income means what we generally know, bonds, debentures. The third is derivatives, what we normally know, forward, future, options, swaps. And fourth is alternative investment. This is how globally the assets are classified or investments are classified. The alternative investments include all except equity, fixed income, and derivatives. Some of the examples of alternative investments are real estate, commodities, private equity, hedge funds. All these are the examples which come under the category of alternative investments, also known as AI. So AI in finance is alternative investments. Anything which is not in the first 3 category naturally falls under the 4th category. Now, for our understanding, let us have a broader look about investment avenues. So we can classify various investment categories as equity shares, bonds or debentures, non-market financial instruments, then insurance product, then pooled investment, pooled investments, also known as collective investment schemes, what generally we call as mutual funds. Normally, we call it mutual fund, but there are a lot of other products also. Then money market instruments, which are short-term investment instruments, then real estates, then precious objects, and derivatives. So these could be the major asset classes we see in India. Now, in equity shares, we have blue chip stocks, also known as large cap, mid cap stocks, small cap stocks. The classification is generally based on market capitalization. So the top 100 companies are called large cap stocks, and they usually have a market cap of more than 20,000 crores. Next is mid cap stocks, which are the next 150 companies. That means 101 to 250. And they normally have the market cap in between 5,000 crores to 20,000 crores. And the small cap shares are the companies which are above 250 companies. Now, these small cap shares have a market cap of less than 5,000 crores. This is one category. How this is one categorization of equity shares. The another categorization is growth shares. Normally, the big companies like large cap stocks are known as growth shares. For example, HDFC Bank. So any company which has grown, already grown, have a lesser risk of failure, and they are going to grow, maybe not at a higher pace, but at a steady pace. So these stocks will give you a constant return or constant growth over time. Income stocks or income shares are the shares which are paying dividends regularly. So one category of investors only invest in dividend paying stocks called as income stocks. So they don't focus on primarily, they don't focus on the capital appreciation. They focus on the income in terms of equity dividend. The third is next is value stocks. Value stocks are the stocks which are currently at a reasonable valuation because of any reason. Maybe this year their financial statements are not good, there is any strike. So by that reason, by any reason, these shares which are good but now are available at a cheaper valuations are called as value stocks. Also, there are cyclical shares or cyclical stocks. Normally, many industries like metal, they are cyclicals. So cyclical stocks means which have a tendency or have a fixed cycle, they normally follow that cycle. So for a particular cycle, they will be having an uptrend and then they will be having a downtrend usually, and that is predictable. The next category is bonds. Bonds means debenture. This could be public sector undertaking bonds. This could be government of India bonds. The most popular category with Indian people is non-marketable financial instruments or assets, and they are bank deposits, POSB. POSB are post office deposits like MIS schemes, Indra Vikas Patra, Kisan Vikas Patra, company FDs, and provident fund schemes. So if you go and ask your parents or grandparents, they are for sure must lie in this category. And apart from them, there is one more category. This is insurance because of largely tax advantage. Because of the income tax 80C benefits, they are investing in the insurance. Then comes mutual fund schemes or pool investment schemes. Then short-term money market schemes, including treasury bills, CPs, CDs. The next is real estate, could be agricultural land, urban land. REITs is real estate investment trusts. This is a somewhat new concept in India. So you can buy a piece of land just like a share. So that is known as REITs. You can invest in precious objects like gold, silver, platinum. You can invest in artifacts. Artifacts is a very popular investment horizon, especially in Europe. So those people have a good market for artifacts. Last is derivatives. These are basically the main investment classes available. So let us now have a very few quickly view about what happened in various asset classes. This is the history of 2 years for various asset classes, what kind of return they have given. We can clearly see that during these 200 years of period, it is clearly the stocks that have given, stocks means shares, that have given the highest returns. However, these returns don't come free of cost, they come along with a high risk. But investors usually want returns and don't consider about risk. However, the main factor to consider is to think about risk rather than the return. In fact, the return is the last topic to discuss when we think about investments. Now, so risk and return are required to be matched, and these are the attributes of the investors. Along with these objectives, there are many constraints, and these are very specific to every kind of investor. Now, what are these constraints? These could be taxability. Taxability means, say, a university or a hospital have the sole criteria of making investments depending upon the taxability, because they have endowment funds and those depends upon, that is a huge fund, and they want to make investments to save tax. As well as there could be the differentiation in terms of the time available to the investor. It could be an investment for short term or long term. The liquidity is a major concern. So based on the liquidity, you can decide. So what people normally prefer is more liquid asset classes. That means more liquidity means whenever you want to buy, you can buy. Whenever you want to sell, you can sell. If there is lesser liquidity, it may be possible that you are willing to buy, but there is no seller, or vice versa. If you are willing to sell and there is no buyer, so nobody wants a market which is illiquid. The another is regulatory aspects or legal aspects. That could be a constant. Maybe, for example, investing is in real estate could have more legal consequences than making a fixed deposit. So investors may differentiate based on this constant. The last one is uniqueness. Uniqueness is generally a self-imposed constraint. It could be, say, for any investor may decide that I will not invest in any liquor stock, the company making tobacco products or making liquor, I will not invest in that company. So that is uniqueness, self-imposed. Now, so what I try to say here is that these two objectives and constraints, the risk is the major factor. So safety comes first and return comes second. So there are many books on risk management, but there is not a single book on return management. But normally investors talks about returns, not risk. So there are various measurement of risks, like these are. So focus is on risk management and risk measurement and risk management. I need to skip few things. Now, the most important factor is diversification. So you can always minimize your risk by doing the diversification. Let us talk about one product directly. This is ETF. So ETF is a kind of pooled investment product very closely related to mutual funds. It is almost like mutual fund, but technically there are some differentiating factors between ETF and mutual funds. So one of the most important investment avenue available for a retail investor is to invest money in ETFs. So why investing money is so popular? Investing money in ETFs is so popular. It is because of low cost, tax efficiency, diversification benefits, transparency, and exchange access. So ETFs nowadays are the most popular instruments. And why I also think ETF is one of the best investments for any retail investor. It is because that investing in ETFs is very much lesser risky than investing in any other product because of the diversification benefits. If you invest in any company, however large or good that company is, has always the risk of going bankrupt any day. However, ETF invests in indexes normally. So whatever happens to a particular company will not have any effect on the indices. So your investment is almost risk free, or there is negligible risk. Now, I want to show you the history of ETF in India. This is the history. The first ETF introduced in India was way back at the start of this 2002, when we have Nifty Bees. And this Nifty Bees, the performance, I want to show you how this Nifty Bees have performed over time. If you can see here, Nifty Bees performance, if you can see here, this is the 1-day return. This is 5-day return. Let us come to 1-year return of Nifty Bees. 1-year return of Nifty ETF, Bees ETF is 26%. If you come to the 5-year return, it is 107% return. And if you come for the maximum period, means since the start 2002, this have given you a return of 2300%. So this kind of return, if you give time, if you keep your money untouched, and this is relatively safer avenue. So by investing in any ETF, you could have a decent return over time. So that's all from my side. If you have any questions, you may please ask.
Ankur sir, actually there are two questions in the chat box.
Okay.
The first question, which is there, that which is the right time to invest in stock market. You have already discussed about it, and you have given a very descriptive overview as to how to decide and when to decide. The next question which I can see is how a person can understand which investment options are suitable for them. So can you just give a overview
Okay.
on that?
Okay. So to judge what investment options are suitable for you, you need to have the risk assessment. And that risk assessment differs from person to person. So no two persons have the same risk tolerance level. In terms of risk, there are two different factors. One is ability to take risk, and second is willingness to take risk. So we have certain methods through which we can judge the risk appetite of an investor, and based on that risk appetite, the product category, the investment or asset category is to be selected. So whenever you are doing any investment, the first thing You don't compare with any of your colleagues, friends, relatives. You need to have your own assessment about risk. Unless and until your risk assessment is done, we can never decide about the investment platform with that is suitable to you.
Yes, absolutely well said. Definitely risk assessment and going deep into what exactly your own financial status is. You can decide on which option is more suitable. I hope there are no more questions in the chat box or anyone wants to give any comment over here. So, to conclude with the session, thank you so much, sir, for this wonderful session on demystifying investments for the beginners. It was absolutely enlightening to at least understand for the students who have joined over here that how they can start their path of investments at this very own beginning of their career. So it's absolutely enlightening for all of us as well as faculty members who are just finding out their ways as to how they can do their investments and savings for their future life. Thank you so much, sir, for your time and your enlightening that you have done today for the session. Thank you all for participating, and thank you so much, Sharma sir, for giving your time over here as well as the HOD of School of Management. Thank you so much, sir. Thank you.
Thank you, everybody. Thanks.